Welcome to the Scottish Property Podcast. This is a show where we aim to educate, inspire and entertain through real life stories and interviews from people in the Scottish property community.
As always, thanks for listening and give us a follow on social media and subscribe to our YouTube channel. Remember to join us at our monthly networking events on the first Wednesday of every month. Tickets are available on our website. So without further ado, we'll just cut straight into this week's podcast. Welcome to July's market update. We're delighted to have again in the studio Mark Shanta from Shanta Residential, the ultra marathon runner, elite athlete. Mark, what's happening? You're looking absolutely brilliant. What's been happening in your month then? Tell us, first of all, to listeners.
Okay, thanks very much for having me in again, Nick. Stephen, been having, and thanks for the alluding to the ultra marathon. Yep, so I did the 50 kilometre Run the Blades on last Saturday.
Fantastic.
It was a race up at the Eaglesham Wind Farm, and yeah, it was quite challenging. I say quite challenging, it was very challenging. Lost a toenail in the process, 600 metres of elevation, and driving up to the wind farm, I was like, those Bowman wind turbines are going quite fast, aren't they? It's like, that's what happens at a wind farm, obviously. So the actual the conditions were quite tough, but it was a great.
Did you have bleeding nipples at the end of it?
I managed to avoid that. Thanks.
Did you manage to walk into the office on the Monday morning?
I was hobbling in. I did my knee in one of the declines, but that's that's all I'm training towards. I'm running the 7th of October. I'm running the Glasgow to Edinburgh race.
Nice.
So it's 90 kilometres along the canal.
Wow.
So that was like a build-up training
warm-up
event.
training.
What
What was your time for that then?
It was 4 hours and 20 minutes. So it was good. I came 20th overall, which I had no expectations going in, but I was, I was coming to the end of it. I was like, for this run to Edinburgh, this is an extra 40 kilometres. How the hell am I going to manage this? But we'll see. We'll get in there. We'll keep on practicing.
So we all
Get
watch
the
David
miles in.
Goggins' social media for motivation. You actually take it literally and start actually running ultramarathons.
Yeah, I mean, he's an interesting character, David Goggins, but yeah, I mean, I don't take all of that stuff to the extreme, because you do that, you end up getting injured. He's like, just no pain, no gain.
So what have you seen in the market and in your business?
Well, let's just kick off with a positive news story for once, because it's not all doom and gloom. We've got a wee bit of positivity. So, I mean, everything all relates back at the moment to basically inflation and interest rates, right? It's what's driving the market, it's what's driving the property market. So in the month there, just the latest figures from the Consumer Price Index inflation rate, we actually have a positive reading. Inflation has slowed to 7.9% in June, down from 8.7% the previous month. So a bit of positivity there. Obviously now people are coming in hoping that the Bank of England are going to kind of slow down their rate hikes, because we're up at 5% for the Bank of England base rate. A lot of people had predicted that it was going to go quite quickly to 6%, with the next rate increase going to be possibly another 0.5% increase. But now there might be a wee bit of positivity. Mark, what are you thinking about the latest readings?
Positive in the fact that mortgage rates are the highest, obviously they have been in years, but positive with inflation slowing that. We even heard from some mortgage advisors yesterday that this is now going to be the end of July, but that they're getting emails saying that they're from lenders saying that their products are actually going to be coming down slightly. So as things stands, for a buy-to-let, a 2-year mortgage is 6.5%. 75% loan to value. That's based on 5 years. It's 5.8. So
these are averages across the.
Yeah, but so that's where we're at as things stand, and we've heard from some mortgage advisors that they might be getting reduced slightly as well. So positivity, because at the moment it seems to have only been going one way, just keep it going up and up and up and up. So hopefully they get a handle on the inflation. And
the SONIA swap rates have been leveling off and dropping recently as well, so that might help.
He's getting all technical now. The SONIA Bloomberg as well. SONIA swaps. That's what I was saying. Nick's
I've been sitting behind Nick's shoulder watching it 24/7.
Who's Sonia? We need to get her on the podcast. The swap rates basically of what the lenders base the long-term
lending on,
fixed rate. So that's how they base the fixed rates. That all relates back to the bond markets and what they're doing as well. So, the bond yields, UK gilts are down a wee bit, which is all positive news as well. But let's just see about this whole thing. I mean, it's positive now, but the underlying
it's
problem,
only 1 month.
The underlying problem last month when we reported huge spike in mortgage interest rates was that the core inflation. So you strip out the energy and food costs, strip that down, and that's what really was driving the markets, because the core inflation rate last month actually went up. This month we're down. So this is good news. So really keeping an eye on that core inflation moving forward, that needs to keep coming down. And we won't really tell, I think, until we get 2 or 3 consecutive months of down. Then I think that then that's obviously positive signs. But hopefully it's not just a...
Yeah, I think as well, even though we're saying we're starting positive, that saying that lenders might be slowing down their rate increases, might even be coming down a bit, that I think there is a general thought by the end of the year that base rate is going to continue to climb. So we're at 5% just now. I think that prediction is that it'll get to at least 6% by the end of the year, and then hopefully start tailing off next year. So not out of the woods yet by any means, but maybe with the inflation, getting a handle on inflation things, hopefully getting a hand, slowing down interest rate.
7.9%, we're still a long way off the target, which is 2%. So that's a long way to go. Like other countries, like I think the US inflation's at 3% now, so they're doing a lot better. They
put their interest rates up quicker, didn't they?
They did, and earlier I think. So it's quite a different. It's very much different mortgage market as well, because over in the States they fix in for like 30 years. It's like standard. Over here we're like 2 and 5 years, so that's kind of quite different. But there's another wee thing that I highlighted in this news article, and this is just taken from the BBC, by the way. But the next decision is on the 3rd of August, so it'll be interesting. We're recording this on the 25th of July, by the way. By the time it comes out, this will be the week of the Bank of England's decision, and it's expected to go to 5.25% now. Before, I think it was going to be 5.5%.
5.5,
Somebody from Capital Economics has predicted that rates might peak, the bank rate might peak at 5.5% now. Before that, they were predicting 6%, but who knows?
Who knows?
It'll all play out. And
what do you guys think is going to be the increase, or is it going to stay the same increase in August?
I think it'll be at 0.25%.
I hope so too.
Hope so.
Not sure. Hope.
You not think they'll go aggressively to try and bring it down a little bit quicker and go to half?
I think that they need to let all. I mean, if you look at the last 18 months, what it's come from 0.1% up to 5%. I think they need to allow it a little bit of time for things to start playing out, because they call it a blunt tool, right? So it's not like they rise the rates like that and something happens the following month. It takes time for it all to filter through. Do you know what I mean? We're still seeing at the moment not really a lot of pain in the general economy.
The market's still hot.
Recessions have been getting predicted now for the last year. Keep hearing like, there's going to be a recession next month. There's going to, it's not happening yet. So it needs time to filter through. I've said in the podcast numerous times before, I think there will eventually be a technical recession. I think there needs to be for that kind of like correction to take place, and that kind of inflation really needs to kind of dampen down because of that. But anyway, getting on to our next
Bloomberg article
segment. No, I've been kind of like, I've not been into Bloomberg that much lately. No, I've been
the diction calming down.
You and I tried to shift this negative nickname, aren't you? Starting off positive, I think he's going to go for positive Nick.
Positive Nick's on the agenda this month for sure. And
that's 2 months in a row.
We are continuing in a positive note, because
lovely.
if we look at the UK house price index, so again, there's numerous different house price indexes and numerous different news articles saying different things wherever you are in the country, but we take the Registers of Scotland ONS data, which is the recorded house price data, which you see when you look up Rightmove house prices, the registry
the land
data,
registry,
land registry basically. We're seeing an annual price increase of 3.2%. let me just read you this out. Average house prices in Scotland increased by 3.2% in the 12 months to May 2023. So this is another thing. This is a lagging index because we don't get May's data out until July, so it's a bit of a lag. This was up 1.8% in the 12 months to April, so it was up from 1.8% was last month. We're now at 3.2%, so it's gathering a bit of speed. And was faster than the average UK house price annual inflation of 1.9% in the 12 months to May 2023. So Scotland doing pretty well on the grand scale of things is what I'm reading here. How are you finding, obviously this is all regional dependent, because we pick up like the Daily Mail and we're seeing like house price crash, experts predicting 30% crash and the rest of it. I think a lot of that data is taken from like London and the southeast. But at a local level,
what we're finding in Glasgow, it's like you can even break it down a wee bit more. The first time buyer market, so properties up to traditionally like £150,000, but you can play about with that a wee bit. They're still fine. They're still buoyant. Every property that comes on at that level tends to sell well, tends to sell by home reports, keeps going up in value. But what we're noticing, and spoken to quite a few agents, surveyors, other mortgage lenders, other people in the industry, is that there is that mid-market at the moment is struggling. So the 200 to 400 grand houses, they're the ones that are taking longer to shift. They're the ones that are maybe getting reductions in prices or going to fixed prices or coming down slightly in
and why
value.
is that, do you think?
Well, we've talked about this before, Nick, as well. I think that's the market where people are nervous to enter. Suddenly that's traditionally like the second time buyers
stepping on ladders.
So first time buyers are it's still fine, because to get a flat for 100 grand, you maybe need a 10 grand deposit. People have traditionally been able to borrow from their mums and dad. Doesn't take a huge amount of pain sometimes to save that up as well. So that market is still okay. But
and then you look at the alternative. What's the alternative to first time buyer? Is renting.
Exactly.
Look at the rent prices.
Exactly. So for 150 grand flat now, to rent that in Glasgow where we are, you're probably anywhere from £800 to £1,200 a month, and your mortgage on that, if you were a first time buyer, might be £600 a month. So it's actually cheaper now for these first time buyers to buy, pending getting a hold of the deposit. But where the real sort of struggle and pain is that we're seeing is that 200 to 400 grand market, and I think there's a nervousness from people overstretching.
Breaking my heart. I'm just waiting to put a property on the market this week at 350.
Well, I hope it's unique. There's some good selling points.
It's funny because when you read the stories, you actually look at. I don't know if you'll think. Well, I know I'm the positive Stephen and you to the negative Nick, but I look at it from the optimism point of view, and I read an article recently saying that people that were buying houses, because it's in the countryside a lot bit, that I think it was some like 40% of the people didn't need a mortgage. So I'm hoping that helps the type of property type that I'm selling. But yeah, I've noticed that as well, that 200 to 500 mark.
But where we've come from, where we've come from 2 years ago, where base rate was 0% and people were borrowing at 2%, and they were going out and they were getting easy finance and cheap finance on Range Rovers and different cars and stuff like that. They're essentially levelling up. They were debting up right up to their eyeballs.
Because they could, it was cheap money.
And that cheap money is no longer available.
What was it, the Davy Hutton quote the other week was the Range Rovers now become, the Evoque Range Rovers now become the new Ford Cortina.
It seems so easy for people to get their hands on them, but in reality, though, that market is the one that's finding the slowdown, and people... And then you're having people actually needing to exit that market.
Is it because of the transactional that less people are putting their house on the market at that level as well? People are staying put?
Yeah, some people will be staying put, but some people will also need to exit because then their mortgage terms coming up and they were fixing at 2%. Now they're looking at 6.5% or something like that. For our 300 grand mortgage, this is it's nearly going to double. Do you know? And we can't afford that. So they're then looking to exit that market. But there's a lack of buyers, so there is a bit of pain we're finding in there.
You see how that's just changed so much in 2 and 3 years, because remember it was the whole kind of, this phrase was the race for space. So everybody was looking to get bigger homes out from the city and all the rest of it. So they were, when mortgage lending was cheap just after the pandemic and all the rest of it. And now you'll see like the bigger homes probably struggling now because the people look at it and the affordability.
They were really pushing their boundaries. But 2 years ago, they were really, really pushing them out and pushing the boundaries. And now it's the case where I think people are being more reserved. They're actually looking what a 300 grand loan is going to cost them in real terms compared to their wage, and they're like that. No, we're just going to stay put here. And so that market's struggling, but the first time buyer market in Glasgow is still pretty.
Do you sell anything over the 400 grand mark where there's maybe the reliance on the mortgages isn't as neat?
Yeah, occasionally. Like I wouldn't say it's our main. Yeah, by certainly no means. But yeah, occasionally we'll do that, and like speaking to other agents, surveyors. Like again, I think they're finding struggles in that, but then you obviously get some wealthy people in that range.
Yeah, there still seems to be a lot of cash buyers in all kind of sectors as well, so that's obviously supporting it. I think that I just don't see. I mean, you hear about these headlines about a crash and all that. I don't think. I mean, my predictions at the start of the year were 10% down by the end of this year. And my predictions are not looking too good at the moment in Scotland.
But the thing is, though, it's like fundamentally, and we talked about this last time, there's not enough properties in Scotland. There's not enough property for people to rent in Scotland. There's not enough people for social housing in Scotland. So fundamentally, there's obviously a need. There is a need
to balance out. Probably flatline for a few years now. I'm kind of thinking. I'm still hoping I'll get my prediction right.
You're hoping.
I don't think we'll get any money on it. But what I'm seeing as well is that there is, this kind of like investor market that we operate in. That's still quite competitive, like you say, because we're kind of competing against the first-time buyers as well, aren't we? So these things are still going in and up to 150 grand. Decent areas of Glasgow where we operate are still going for home report and above.
Yeah, I would say, like, I've found that the buy-to-let market is definitely slowed down a bit for people, those buy-to-let investors, just because I know we touched on it earlier. The cost of their finance is gone up. But we're still getting some investors in the buy-to-let market who maybe they're not fussed about it. They've got money, they're quite wealthy. They need to park that 100 and 150 grand somewhere, and then they're seeing that opportunity where rents are now anywhere from 800 to 1200, and they're getting a good return on it. An asset class.
It seems it's getting more competitive for the guys that are looking for your BRR strategies, but the ones that have got the money to invest in property are going to get good opportunities because of the higher rents. Yeah,
I think the BRR strategy is very, very tricky just now. I think you'll need to make that work. You need to get a property considerably below the home report value.
30, 35, 40% below now,
exactly.
Okay, look at this, Stephen. I've got a nice stat to present to you here. So I always slag Aberdeen because it's always like the highest negative declines in the whole country. So
it's not looking that way at the moment.
Well, I mean, we've previously reported, if you look back the last 2 episodes, the last 2 months, it was like negative 7 to 8% annually in Aberdeen, right? It's now negative 3.8. So
Angus is at -2. You've now got Clackmannanshire at 3.6 negative. So we've got negatives now, not just Aberdeen for the first time in 2 years.
Look at the main cities in Scotland. So Aberdeen negative 3.8, Dundee negative 1.5, Edinburgh plus 4.6%. Well, they're still doing pretty well. Glasgow, see a lot of cash buyers soon. Edinburgh. These people coming up from England and all that, buying big mansions and stuff. Glasgow plus 1%, and so looking at that, we're still all right.
We're still at if you average them out, we're probably at a flat line. Probably at 0%. So
and I might start considering Aberdeen now as an investment.
You've said this for the last 18 months, Nick.
It's just about
do you know what I found hilarious? And I actually commented on Paul Cummings' post the other day. Do you remember when we were in it?
Yes.
Did you see it as well?
He's now all in Aberdeen.
So we had it was last January. There was COVID was still kicking about. There's a bit of lockdown, and the only event that we didn't cancel was Edinburgh. So we all gathered in Edinburgh, and I think it was Linda Martin and Gary Wales had says to us, like, kind of the other hosts are all here. what's your predictions for 2022 and what you're getting involved in? And I just said, look, I'm in Aberdeen. There's nowhere else I'm getting no money in properties, all my money back out of them. The emotions out of it. And Paul Cummings was like, the emotional side of it, because he was in the oil and gas industry and he had saw it from that negative effect where people were losing their houses, handing their keys back into the Audi garages and stuff. He was like, no, he's driving past. I'm driving past him on the way up. He's driving past me investing like Lanark and stuff like that. And he was like, no, absolutely not. I was like, you're putting the emotion into it. And now I've seen him, he's heavily investing in Aberdeen.
Despite living in Aberdeen.
Yeah, he lives in Aberdeen, yeah.
So like he was saying that he wouldn't invest in Aberdeen. That was like, what, 2 years ago?
2 years ago, yeah.
Aye, but now he's changed his tune.
Yeah.
I was going to pull him up for that as well.
I did. I thought it was quite funny.
So, right, okay, moving on from the house price data then.
So you guys want to come out to Aberdeen, you can...
Arc probably move up, get a wee branch up there.
Definitely start, Chris Minchin will be on to me.
Stealing his clients.
So, moving on from the house prices. Well, actually, just touching on that, which is quite interesting. I like to look at the Rightmove data because they give, I always like simplistic data where it just puts out in a nice wee map. And if you look at the Rightmove house price index, looking at the country as a whole, Scotland, so these are current asking prices on Rightmove. Yeah. Scotland on year, it's up 3.6%. That ties in with the registry data. But if you look at the London and the South East, they're starting to show declines now. They're starting to show falls, annual declines. So South East, negative 0.4% and stuff like that. So I think those potentially are going to be the markets that you'll see hit first. When you're talking about buying properties, you said yourself there, the higher value properties. Yeah, you're down in London and the South East, you're talking about minimum £500,000 pretty much. They're the ones that are going to start feeling the pain and the affordability issues, the stress tests, and the mortgage interest rates. Do you know what I mean? So that's pretty much tying in. It makes sense, like you say.
It's interesting that we're still getting growth, and it might make Scotland more attractive for the investors south of the border that are looking to invest up in Scotland if we're still getting growth and we're getting good increase.
Investors down south are like that. What's the 6% ADS up?
That's true.
Up here, do you know we're used to paying 3%? Why is it 6%?
Moving on to rent prices, guys. God, this is again, it's just an absolute disaster by the Scottish government because we look at rent. And I'm taking these stats from again Rightmove, and they produce their quarterly figures. So on their quarterly figures, again, I'm just looking at the map of the UK, and where do you think has seen the biggest quarterly rent increases? Scotland, yeah. So we're going to be attracting all these English investors up. So it's just if you look at it, right? So Scotland's up 4.4% on the quarter, London 2.6%. Northwest, we always hear about Manchester being the place to invest at the moment, 3.7%. Annually, 13.7% in Scotland. Northwest, Manchester, 11.6%. So
we're outstripping everywhere else in the UK. And shows the effect of the Scottish government's interference.
I know another thing is that 13.7%, it's not even regionalised to the hotspots that we're dealing with in Glasgow or Edinburgh. Yeah. Again, that's taken in the whole country, whereas you're just saying, there's Manchester's.
These are newly listed properties, obviously. I wish we could put up 13.7% on our existing rents for some of them. But
it's just ridiculous, and it all does stem from the Scottish government and the interference in the policy. And they think that the policies that they've been introducing are helping the tenants. They're saying, they're thinking the 3% rent cap that they've introduced is going to help the tenant because their current situation their current rent can only go up by 3%. They think that having an eviction ban is helping the tenant because they can't be forced to leave the property, but it's having the opposite effect. It's having the opposite effect, and that's showing that in the data there. And the 3% rent cap has, now landlords are just applying that across the board annually because that's what they can do. But what we found with this 3% rent cap is that because other costs are going up, because cost of living is going up, because mortgage rates have gone up quite exponentially, the landlord now can only pass 3% of that onto the tenant, and it's now becoming unaffordable for the landlord to have this property. So what they're doing, they're selling, they're giving notice. And I was saying this to Nick earlier, it's like, I think by the end of this year we'll have anywhere from 5% to 10% of our managed portfolio give notice to sell.
That's interesting. I know that Sam there was getting a right hard on about this 3% rise and thinking you can see it every year, and he's got it plugged on his spreadsheet and drives me nuts. But the reality is the exact opposite. Yes, it's nice that it's going to become more professional and we're getting to rise the rents up minimum 3% or whatever we do. But the harsh reality is we've got products that are coming like every month that were fixed 2 years ago that have went from somewhere between 2.75 or 3.2% now gone up to 6%. So yes, we're getting to increase our rent by 3%, which is probably giving us about £19 a month, but our mortgages went up £300 a month.
Yeah, and
so that's the reality of it. You've lost the cash flow in the properties.
What's happening is the landlords are like, well, this is just no longer affordable. Yeah. We could take a wee bit of a hit. Do you know? Yeah. Like if we could increase, in your scenario, increase the rent £150 and everybody's happy.
There's a bit of balance, yeah.
There is, but if they can only increase by £19, they've got left with no option but to sell.
I think that again separates the portfolio landlords and the serious investors from the amateur.
Yeah,
because I'm finding that the ones that have become vacant in the last couple of months, I've managed to cushion the blow on the other ones that are basically breaking even. Yeah. Because I've managed to really hike the rents by some of them £350 to £400 a month, extra compared to what I was getting.
What we've had on a few occasions is this exact scenario where the landlords said, look, I just can't afford to do this anymore. We're giving notice. We're explaining this to the tenant, and the tenant's coming back to us. They don't want evicted, obviously. They don't want evicted, and they're like, is there anything we can do to keep the property? Like, they're voluntarily offering more than the 3% and things, do you know? And
which is, again, pushing them into that red zone of not being able to afford, and it's making them worse off, which is going against what the government's actually trying to do. So it's putting them in a more vulnerable, worse situation, all because they can't get their act together and build enough houses, basically. Let me throw a stat at you.
I think you mentioned it as well, though, it's that the portfolio landlord won't be suffering as much because you've got a balanced portfolio that, like you say, if some properties are becoming vacant and you can get the rents up, and some mortgages are coming to the end of their terms and some are still on a longer fixed term, you've got that bit of balance in the portfolio. But the ones that are starting out have only got a handful of properties, or the accidental landlords, these are the ones that will probably exit the market quite quickly when this, because they won't be able to afford to hold the property.
My issue is now is because of this, and because landlords can't increase the rent marginally during tenancies, that power's been taken away from them. But there is opportunity to do it when property becomes vacant. So what's happening is some landlords are pushing the prices up to the maximum they can possibly get. So you can essentially have two properties and they're exact same in the same block. One's had a tenant for 4 years, so the rent's £700, but it's come back, the next door neighbour's just come back on the market and it's £1,400. Do you know, there's a massive discrepancy of this.
I mean, I'll give you examples of that, like cottage flats in Glasgow, well-known sort of investment property for a lot of landlords. They stuck it around the £500 a month mark, £550 a month for years and years, 10 years.
Yeah.
We're now looking at cottage flats, which they're not the best of properties, £900 a month now in
standard,
Kings Park in Glasgow. You know, I mean, you just think, how that's not sustainable. It's not healthy.
No.
You think, oh, that's great as a landlord, but long term, it's not good for anybody. A stat here is by Rightmove, average asking rents for new tenants are now over 33% more than pre-pandemic 2019 levels. 33%, that's over the whole of the UK.
Did you not look at a stat though then, and you just mentioned it on your last statement, that rents had pretty much stayed the same for 10 years. So if you took it, I mean, I know this is headline figures and pre-pandemic, but what happens if you took the prices from 2009 to 2019? Would there be much increase? Because I mean, the properties I've got, there's probably not much increase at all over that period of time. So it's 33% in 3 years, but if it's 33% over 13 years, it's not that much.
Yeah.
It's basically in line with inflation.
Yeah, but this kind of sharp rise of 13% year on year at the moment, which has been happening for the past 2 years, just it's not sustainable. Tenants should not be paying, people in their homes should not be paying any more than 30 to 40% of their take-home pay of their net income on housing
It kind of
costs.
brings me back to Sam's point on the 3% rise. He believes it's a really good thing for the economy, the market going forward, for the private rental sector. And when you look at things like that, it probably is. If you can just put your rents up 3%, and that's a standard every year, we probably wouldn't find ourselves in this position again, because we didn't have any growth for 10 years. Now we've had huge growth over a 3 or 4 year period. Okay, it's not just as simple as there's all the external factors on that.
Yeah, what I think that the discrepancy and the main issues that we're finding is that the landlords want to push it up as high as they possibly can, and people might think, oh well, initial reaction is that's just greedy, you're taking advantage because there's a shortage of supply and demand in the market. You know, we're taking advantage of that, but the main driver for that is because once that tenant is in the property, the flexibility of the landlord is taken away, because going forward they can only increase it by 3%. So if the base rate continues to climb going forward, they can only do that. And also currently there's an eviction ban on, so they can't increase the rent, or they can
hedging their risks.
Exactly. So they're like, well, we're going to get it as high as we can right now, because we don't have this flexibility in the future going forward, because that has been taken away from us, and that is helped cause this massive vacant rent increase.
Moving on, this brings us on nicely to the next article, but just finishing off on that Rightmove quarterly data, a third, 33% of landlords who own lower EPC rated properties plan to sell them rather than make improvements to their EPC rating, compared to 20% who planned to sell last year. So like you talked about, landlords selling up because of all these factors, the EPC's definitely one on the cards. Moving on to our next article, which was actually an exclusive in the Herald on Sunday, a newspaper that I used to work for, actually. So the Herald on Sunday has had an exclusive interview with our pal Patrick Harvey, who we've actually tried to reach out to on a couple of occasions to get him on the podcast, but been totally blanked.
Absolutely no chance. You're getting him on.
So no, basically, Mr. Harvey has come on, and there's been some big announcements on the EPC front. Basically, the article goes, one of the biggest challenges is replacing fossil fuel gas boilers in homes with climate-friendly heating systems such as heat pumps. Mr. Harvey previously admitted the costs could total $33 billion. So from 2025, certain trigger points such as the sale of a home will mean properties will need to meet EPC Band C energy efficient standards, while new fossil fuel boilers will be banned in new buildings from next April. Right, so what they're having a rejig of the EPC.
They're kicking it down the road again.
Aye.
This was meant to come out in 2022, and then it was pushed back to 2025, and now we've been told that we're going to hear later in the year after their heating buildings bill later this year, which is currently going through consultation. So who knows? It's obviously getting put kicked down the road again. Obviously, climate change is a massive issue everybody's facing just now. But the one thing that I would say that I think needs to get taken into account is the private residential sector in Scotland makes up some like 11% of homes. See, if you're bringing in these bills from a green angle, bring it in these bills for the entire country. Don't just bring it in for the private sector. Do you know, if you're talking about EPCs for sales, if you're talking about EPCs for new rentals, if you're
social housing, the whole sector,
for everyone, and that's fine because that's right across the board, and you're tackling a green issue, but don't just make it for one wee small section of the.
So they're going to, at the
policy.
moment, right? So the idea is that the EPC is not fit for purpose just now, right? So if you upgrade from an electric heating system to a gas boiler, you can actually improve your EPC, but that goes against the whole point, because they're trying to do away with gas boilers.
So they're not just fudging the way that it's recorded to fit their political campaign then?
But it's got to happen. You've got to do away with fossil fuel.
But if you're on about, they're saying they want to get rid of the gas boilers, but if the price of gas is half the price of a unit of electricity, then a boiler's more efficient to heat the
Well, no, because it's obviously like electricity, they can do it with renewables. With gas, you have to do it with fossil fuels. So the whole point is we need to get away from that, and we need to go to net zero by 2045, which is 5 years ahead of the UK government's target. Again, it's like I've learned to realise that anything the Scottish government comes out with, not to worry about it, because it's never going to happen.
Well, it does. It just gets pushed. It gets pushed down the line, and you know, the Greens are pushing this policy. Remember, Greens get less than 3% of the vote in the entire country. Do you know, they're pushing this policy through. For me, if they're doing it, it needs to be blanket across the entire property sector, not just the rented sector. But you know that the government does have an anti-landlord agenda, and that's
well. This is the thing, right? So he came on this article, and he said the package of support provided by the Scottish government is already the most generous in the UK, because obviously they're going to have to fund this.
Yeah,
basically £33 billion. It's got to come from somewhere to basically provide homeowners with the grants or whatever to change over heat pumps, right? So he said, we updated the Home Energy Scotland scheme last December, and we will be launching a new Warmer Homes Scotland scheme in the autumn. We have provided specific funds for public buildings, heat networks and social landlords, and I'm excited by some of the plans I see coming forward. Is there any mention of private landlords there? Are we just going to be expected to fund it all ourselves?
Yeah,
absolutely.
But another thing is, it's like, who knows if this is going to come to fruition or not? Because we could have it. We've got an SNP and Green coalition just now, but
that might change.
There might be Labour next year. You know, who knows? And they might come up with something different. So I think that the message is try not to plan too far in advance, because
you get yourself caught up.
Yeah, because we need to be aware of it as private landlords. We need to be aware of the EPCs and the energy efficiency.
At some point. But when?
Yeah.
Do you know, it's like you could have got everything done in 2020 because you hear it's coming in 2022, and then you're like that. Oh, what? It's going to be 2028.
Are you still putting gas boilers in your properties?
Yeah, absolutely.
You got to, because there's no point.
Because the EPC ratings to a certain extent as well.
Aye, well, that's true. But don't worry, we've got Lorna Slater who's going to get all the investment for this. So I have great confidence in her. Not anyway, right, getting off the politics, because we need to wrap this up now. On to our last news article, which is actually from Scottish Association of Landlords. Great, they're actually a great organisation. As a letting agent, I'm on the phone to them all quite a lot.
Me too. They are brilliant. So anybody, there's a wee plug for them. If you have not joined the Scottish Association of Landlords and you're a landlord, it's £300 a year. You jump on, you get a 9 to 5 support anytime. Loads of the documents provider.
I was on the phone to Caroline yesterday at Sal, and she's like, we've been the busiest we've ever been. Obviously, with all this, they keep changing things, the government, and obviously that's driving their membership up as well. So they're absolutely loving it at the moment. But another boot in the
stones.
Aye, another boot in the stones for landlords if you've got stones. Basically, another.
Oh, yeah, that wasn't politically correct, was it? Yeah,
exactly. Just because we're all guys sitting here, but there's plenty of female landlords as well, obviously. So another piece of legislation out by the government, included in the repairing standards, right? So the repairing standards used to be pretty basic. Like, you used to have a property that was wind and watertight, and that's it, right? Now they're saying that from the 1st of March 2024, all landlords have got to, it requires landlords to ensure that their water supply in their private rented properties is free of lead.
Yes.
Right, so we've got the Legionella risk assessment, which is basically a tick box exercise, which is pretty straightforward, but this is actually a test. You need to take the water and you need to send it off to a lab, right? And Scottish Water advises that if your property was built before 1970, there's a chance that you could have lead in your pipework,
which is the majority of properties,
which is pretty much 90% of Scotland, isn't it?
I'm just thinking of all the tenement flats.
Is this across the whole of the UK? It's just Scotland.
Scotland.
So how does this decide to go through? What's the process of this?
So you need to go in, take a sample, and you need to send it off to lab.
And by the way,
who's putting this in place?
The government. That's repairing standards.
This is coming out.
Nick, when was this brought up? This is the first time me hearing about this. Like,
because
you should be prepping Stephen for this show.
Me this shit.
By the way, with your whatever it is 100-unit portfolio, mate, this is got
all have lead in it.
Chris Minchin is going to be rubbing his hands because this is another thing that letting agents are going to be charging for.
Do you know
and a markup on it.
The other thing is that it's to be from every outlet as well.
Oh, is it?
So it's not just the kitchen sink, it's the bathroom sink.
So if you live in Glasgow, right, it's £58.80 for the first sample and then £24 for each additional sample. So it depends how many.
And how often are they need to be done?
Yeah.
No, it's a one-off.
All right.
Let's just see.
Okay.
Do you know, that's the message. Let's just see if this actually materialises, because I mean, as far as we know, it's coming out. We haven't got...
When was that from next year? Like
from March,
1st of March 2024.
We haven't. Who knows if that will get extended? Because by the sounds of thing, this one wee lab in Springburn's going to get inundated with 3,000 in Glasgow. But let's just wait and see what happens. And the other thing is, it's not clear yet if your property was built after 1970, if you're going to need to do that as well. Because in 1969, that's when they
done away with the lead pipe.
Done away with the lead
The thing is though, like, if you've ever seen lead pipes in your properties, where are they located in the most awkward, hard to get
right behind the toilets
places that you can get to? So
how many do we know? Is there any statistics why they're doing this? Has there been deaths?
No idea. It just came out.
It just stuff like that.
It was like, for me, it was like out the blue. It just like landed in my email, and I was like, what?
Your finger wasn't on the pulse. You didn't hear about the consultation going through.
Consultation with the Scottish Government.
Can I just me on? Look back to a previous point.
Yeah,
11% of properties in Scotland are rented. So are the other is this happening across the board for the other 89%?
Probably not.
Aye. When was the last time you checked your smoke alarms?
And why not?
In your house.
If you're doing this and bringing it in for this sector, why are you not doing it for everybody else? 'Cause surely they're at risk from the same.
Yeah. I mean, okay, if there's like you say, if there's been a spike in deaths of lead poisoning, then fair enough. I'm, as a responsible landlord, I want to ensure people's safety, but where are the stats that there's like some mad, like, you know, lead pipes have been there since the 1800s, so like...
It's the same with the Legionella.
Surely they could have done it since. Why have they picked like the point where landlords are basically fleeing the market to get them another thing?
It's just to try and push as many over the edge as they can.
There's definitely an agenda there. Yeah. Patrick Harvey's name's written all over this.
See if send him another email, see if he'll come in and ask
him. Get him in here right now.
Can we ask you about this new legislation on lead pipe test work?
Right, okay, moving on and finishing up, Mark. It's been great having you on the show.
Thank you.
What happens with your own investing at the moment? Where are you seeing it? Me and Stephen had a great discussion that just got released the other week about how we think that buy-to-let's no dead and we're still investing long term. What are you thinking?
I listened to that and I would agree that it was a great discussion. Well done.
Pivot.
I sent Nick that. I sent Nick a text.
He's a Friends fan.
I sent the Friends with the Friends guy of Pivot round the corner. And
is that where it came from?
He put it on his Instagram. I was like, you stole my pattern, Nick. It must be bad. But so where were we with investing? We bought one property this year. Just as I said, it was a good deal. It was below the market value. Renovated it, and we're going to refinance it when it's the 6 months.
So you're going to refinance it now?
I know, and that's what we're saying. The other cost that we have to take into account is 6% additional dwelling supplement, 3%. That's what's getting added to the loan from the lender. So it is a good message to people out there who are listening, still thinking of buying through their limited companies, that you're about 8.5% down in additional fees if you're 6% for the ADS and an extra 3% for the adding to the loan. So we're still doing it, but the deal's got to be right. I'm like you guys. I see it for the absolute long term.
Would you buy tenanted stock? But since that seems to be the biggest motivation right now.
I would buy tenant stock, but it has to pass the lending criteria, and this is the issue that I think that a lot of people selling tenant stock are having, is that if you have got 150 grand property and the rent's £700 a month, it's like a 5%. It's 5% return. That's not going to pass any lender stress test, so you're not actually going to get a mortgage on it,
or you might get 50% loan to value or 45. Exactly.
Stress test, So buy tenant stock if it stacked up from all angles.
Yeah, no one's probably going to have the rent where it needs to be.
Nope.
Especially now.
Well, you're minted anyway, mate, without your buy-to-let, so you're just ploughing all that wealth that you're accumulating into your
Slowly leave the
investments.
money in
So, listen, it's all good. Thanks for coming again. We'll see you maybe in a few months. Come back
I'd love to.
give us some more updates.
I'll maybe give you next time I come. We'll give you a 2024 prediction of house prices. See, we can have a wager on that.
We should.
There we go. Thanks very much for joining us, Mark. Cheers
Guys. Appreciate it.